right. Hey, everybody. Thank you so much for joining us on another Suma Power Hour. I am so excited not only to be with Luis in this stream, but actually we get to be together because we're both at a conference in person, and we're like, let's just do this together. So we're excited to have this conversation. Whoever joined us last time, Luis, you and I talked about our passion for fundraising. I don't know that anybody's really passionate about it, but our passion of really knowing the tricks and tips that people need to know when they're raising capital. I know you've done it as an entrepreneur, and now you advise a lot of small business owners.
We do. It is the biggest challenge we have, and it's an obstacle that we all have to overcome, right? Asking for money. How do we get money? How do we get capital? What's the process to do that? And there's a lot of ways to go about it. So hopefully today we can cover some of those. Hopefully you can learn something from it. And get some great resources while you're at it, and continue that challenge. I mean, entrepreneurship is a lifestyle. Right?
See, and it's not for everybody, right? And I'm going to apologize because I did not fully introduce Luis as he deserves, but I just think everybody knows you, amigo. So I'm like, okay, no need for introduction, but I will give an introduction. Luis González is the VP Small Business Growth at Wells Fargo. And so we're so lucky to have him here, have all his insights, his passion for supporting entrepreneurs wherever they are in their journey. Because obviously it's very different when you're just starting out with an idea than when you need capital to really fuel that growth. But we are going to be talking about all of that today.
Great.
Right? Okay. And, as a reminder, please put your comments in the chat. We will get to them, or we'll do our very best to get to them. Don't wait till the end. We'll try to, if they are related to what we're talking about, something that you want to know more of the topic that we're talking about, we'll do our best to stop and address your questions. But the whole idea is that this session is useful for you guys. I have to say that most of the people who reach out to me, I'm sure to you too, Luis, is to get advice on how to raise capital, right? And there are so many nuances there. Like there's not a one answer fits everybody.
Correct.
So today we'll do an hour with the most common questions, but obviously we're open to your questions. So hopefully you're going to find this very, very useful and ready to get going.
Let's go.
All right. Okay. Let's start by talking a little bit about the different types of capital, right? Because, sometimes I've had entrepreneurs come to me and say, hey, can you help me raise venture capital? I want to remodel my restaurant. And I'm like, I'm not sure that venture capital is the right thing to remodel a restaurant, right? Might be better to have a loan, a line of credit. So do you mind giving us a little bit of a prep, Luis, on what are the different types of capital? If you're an entrepreneur thinking okay, I think this is the right time, what should entrepreneurs be thinking about?
Great. Absolutely. And there's going to be a lot of language that we throw out, but it's good for everyone to know because you're going to see it a lot in the industry, or when you go out to the community, you get to see a lot of these conversations. So really capital, there's a lot of different forms of capital, obviously, and we'll start with just descriptions first.
Okay.
You have what's called dilutive capital or non-dilutive capital. All right. And it's real simple to understand the two. When we talk about dilution, you're talking about your ownership of that.
Your own dilution.
Your own dilution.
Right. So it means you're not whole anymore,
That's
right?
That's
you have less and less of that pie.
Correct. So when you talk of non-dilutive capital, you're talking about that type of capital that doesn't impact the ownership or your asset as your business from an ownership perspective. So non-dilutive capital would include credit. It would include secure lines of credit. It would include different forms of loans, right? Or we call it debt capital because you're actually getting, a debt. You're incurring a debt to actually pay back that debt. So you get that type of property. The dilutive is a little different. That is when we're talking about equity-based capital. That's when an investor comes in and says, I'm willing to invest in your company, but I want to invest in exchange for ownership, therefore diluting your ownership. So that's why it's called dilutive capital, because it is diluting your interest in that ownership model that you structured for your company. So when you start looking at this, understand those terms are so important and so critical because you understand then what type of capital you're looking for. The majority of small businesses will probably stay in the non-dilutive capital side because it is more understandable. It's easier to access for many ways. It continues to maintain your ownership model, so you're not giving up a portion of your company. And then when you look at to the dilutive side, now you're looking for really big growth, right? There's a series of steps to take, right? Everyone's here, Series A, Series B, Series C, and then eventually get into like public offerings, right? Now that's if you want to really go big and you want to take your company, shareholders, and that's a whole different type of process of capital that requires a whole different conversation in its own. But when you start off and you're looking at your business, you have to ask yourself, where do you want to go, right? And the type of capital that you're going to need is going to take you to where you want to go. So if you're non-dilutive capital, right, your debt-based, your credit, your factoring, which is revenue-based finance, we'll talk a little bit about that. Those types of capitals is what you do with your banking partners, banking institutions. Friends sometimes can help you lend that money, say, hey, pay me back. And then versus your dilutive, which then definitely requires you to find funds, investors, different folks that are willing to take on your investment. But that is a whole different conversation when you're ready to see big growth in your business. So dilutive capital may not be the approach for everyone off the bat if you're just starting your business, or you have a few years in, or you just need a little bit of money to offset some expenses, or you want to grow your business a little bit, but you're not looking to franchise, take on multiple partners yet. You're not looking to see that level of growth.
Okay, perfect. And one other type of non-dilutive capital that is my very favorite type of capital is grants. I know grants are not right for every company, but if you are able to secure them, I would always encourage people to secure them. And you and I, through Wells Fargo, and myself through my own family foundation and through the Annenberg Foundation, support many entrepreneurs in Los Angeles who are first-time entrepreneurs of all backgrounds or walks of life, through a program that we have called Pledge LA, where we not only give you the mentorship, but we also give you some seed capital, let's call it, right? Initial capital, so you can start or grow your business a little bit. Can you talk to us a little, although it's harder to secure because it's not that available, talk to us a little bit about the potential to get those grants as an entrepreneur, which you don't have to pay back most of the time, but you do have to report on the impact.
That's right.
Okay.
So grants are another it's another capital. It is non-dilutive. Obviously, we just covered that because you're not giving up an ownership or an interest in doing that grant. But it does come with specifics. What do you want to accomplish with the grant? What do you want to do? How are you going to measure against it? And then how is that money going to create growth for you? Because that's important, right? This isn't just money to just cover, hey, I like an extra, $1,000 for cash flow or something like that. It really is for a defined purpose. And there's a lot of programs out there, nonprofit institutions, community development financial institutions, or CDFIs. That's what they're known for. All these organizations will offer grants that allow you to cover or offset costs. We're seeing that right now in, especially disaster recovery, when there's a lot of disasters that happen across the country. Disaster mitigation, like through the SBA or FEMA, will come in and often say, hey, we have grants to support your business where you don't have to repay that money. Grants are great, but they do come with a lot of requirements and reporting and structure. So you have to be ready to, obtain those types of grants. And that's why it's great. And we're going to talk about this. You have to have your budget and your entire financial house in order. And that is probably the most critical thing you need to do before even reaching out for capital, is having your financial house in order. What is your budget? What does that look like? How much can you afford? What are your assets? What are your liabilities? Right?
Or your projections.
Your projections, right? Your forecast.
Right.
Even current ratios. I'm throwing out a lot of stuff out there. But there is some stuff that you need to be aware of before, because when you look at grants, you have to report, how was your grant used? Show us the budget. Show us, how you broke that down. How did this, line up? And if you, make up numbers, it's going to get caught when you submit your, P&L, your profit and loss statement, your budget. You're going to say, wait a minute, that doesn't make sense.
Right.
And so you don't want to go using grant money and then not doing the work that the grant was supposed to do.
Of course. And even to get the grant, as you're saying, you will get questions for sure, as far as like, okay, what are your projections? How, and even if it's just for impact, you will be able to also, they will ask you, how are you going to impact this community, or how are you going to make more jobs available, or whatever it is, right?
Right.
So I think that's super, super critical. Okay. And we have some messages in our private chat that I have no idea what they say, but you are our good eye reader here. Yes. So tell me if there's anything that we're missing in this area. I mean, obviously we have a lot to go through, and we just talked a little bit about non-dilutive, which is, again, capital that is not gonna take away from your ownership. And something that's super, okay, go ahead, Luis.
Yeah, no, it just said a question there. It said, how do I explain my business potential to lenders if I don't have a lot of financial history yet?
Oh, that's a great question.
Correct. And this is where it's important to have a relationship with your banker, because each industry is so unique. E-commerce is different than your traditional brick and mortar stores. If you have, a machine shop, or you have invoicing that's done with government contracts, right? They often pay 30, 60, 90 days out. So each business model is very unique, and you need to work with someone who understands your business. And that is why it's important for you to start building those relationships early on, is to explain the business you're in, because there isn't one size fits all, right? If you just started your business, 2 months ago, that may be more challenging because you really don't have a history of saying
2 years of financials.
Oh, right.
It's not gonna
yeah.
happen.
Most financial institutions want to see a solid 2 years of revenue,
right?
That shows that you're making money,
Okay.
of some capacity. But the reality is that when you're starting your business, you still need to show ways that you can leverage that. And that's where there's different options. You see people that start their business, they're in the beginning phase. They may go to like the SBA, who's looking to certify, and underwrite their loan. There's options for people to explore, but it starts with your case is specific. You need to have a relationship with a banker who can understand the business you're in, and then you need to demonstrate how your business model makes money. At the end of the day, that's how you're going to be able to understand what you can do. There's also other types of financing options or loans, such as factoring, which is revenue-based financing, where if you have invoices, but you haven't gotten paid on those yet, there are folks that will lend on that invoice.
But sometimes the interest rate on that is really high.
It's very high, and I think that is there's programs that are being evaluated, but that is one option, and you see that happening in places where you don't get paid upfront. Sometimes you have to wait 60, 90 days for a check to come in. So you have to
feel that pain very constantly.
So there may be ways to do that when you're starting your business, but you need to then factor that percentage into your revenue. So if it adds 15%, that's going to add 15% to your cost.
Of course.
But those are things to consider when you're looking at that. So it's not a one size fits all.
Okay, so let's go back into the 2 years ideally of revenue, right? And does it mean just having revenue, or does it mean that you have to be profitable?
So here's the thing, right? You need to show that you are generating revenue, right? And you want to see a profit, right? The whole point of being in business is to show profit, and ensure that that's something that's being done. Now, I will say this. One of the biggest challenges you see with a lot of small businesses is they pay everyone except themselves.
Yes.
And they say, okay, I got to pay my employees. I know, and I've been through that. I understand that.
Oh, yeah.
But what ends up happening then is that, you're not demonstrating that you're also generating money, that profit, right, for that business to keep going. And so you need to do a couple of things. One is make sure that you're demonstrating you can pay yourself, right, because you want to show that. And then after all that's said and done, there's different ways to approach this when you look at the formula. And if you break even, that creates a very interesting question. And that's where each bank and banker and your underwriting department is going to evaluate risk completely different, because you could be making $10 million your revenue but breaking even, but you're making $10 million in revenue, right? So you're still have an opportunity to show that you can make profit. So that's something that needs to be considered as you start looking at that.
Okay, I have another question for you. A lot of entrepreneurs usually are concerned about not having assets themselves to be able to guarantee a loan. If you are showing that you're profitable as a business, I guess that is less important, or another way to say this. Let's say I'm just starting my business. I need a line of credit, but my company still doesn't have the revenue, doesn't have anything to show, but I have an asset that I could put as collateral personally. Could that be like a swap instead of are you guaranteeing that loan personally, which is terrible. I never want to tell anybody to do this, although a lot of us have done it. Still to this day, for every company, I put my social security to open the first credit cards, and you're like, you have to do what you have to do. It's not ideal, but I'm just trying to think, if you need capital, if you don't have the 2 years, if you're not profitable yet, what's an alternative on the non-dilutive side? We're going to get to the dilutive side because that's very, very different. But staying on the non-dilutive side, would personal collateral be a way to do it, or no? Or how would you recommend?
So again, this disclaimer, right?
Yes.
This is no legal and information.
No.
So
less from me. That I'm not a banker.
But these are options, right? And
yes.
I think people should understand that oftentimes secured, when you start off in any type of credit, you need to have secured credit, right? Which it means that it is collateralized by some type of asset you own. Some people use their cars. Some people use their, if you have a home, you know, they use jewelry. They use anything they have to say, hey, I just need a little bit of a credit. Now, that is one option, right? But again, this is why the basics of any type of budgeting is also building your credit. Yes. And oftentimes your personal credit, and we've seen other entrepreneurs, their personal credit is used, right, to start their business. And that's something to be mindful of, right? Is that you need to start understanding the basics of credit, right? How to maintain credit, how to make sure you're paying your bills on time. That is the biggest challenge we see. And that's something that everyone has to do regardless, right? For your personal life or your business, you have to maintain that credit profile. And that leads to the next question, right? And there's a question I saw there that in the audience that may tie to this, but it's saying, are banks evolving their lending criteria based on the gig economy and hybrid work models? The answer to that is yes. There's a lot of space in the financial tech or fintech space evaluating new business models, right? Mm-hmm. That allow for the evaluation of different ways to see what a true business health score is. Your credit, is not your FICO. Your credit doesn't take into consideration things like cash flow, like how much money you're paying your employees, right? The things that make a business successful.
Right.
So yes, there's other organizations that are testing and piloting new ways to look at how this is done, and creating like a business health score tool. We partnered with an organization that's actually doing this, and that organization is putting together some information. Soon it'll be available on our website, the Wells Fargo Small Business Resources page. So there's a lot of information there as well, that you can then take back and say, okay, how do we leverage this? Now, as anything, we're in the information society, the tech society, where technology, advances way faster than any other, policy or anything can change. And, financial institutions are still regulated heavily. So there's a lot of limitations as well as in terms of how you can use AI, fintech, all these other things we talked about to underwrite, health, credit scores or credit. So it'll happen. I mean, it's just the evolution. It's just that it's going to take some time before the industry, fully gets there and adapts a model that says this is a one size for everyone.
Okay, I want to take a quick pause on something you just said regarding the resources that we can access from Wells Fargo or whoever your financial institution is. I'm obviously biased. You're my friend. Wells Fargo is my personal bank since I'm in high school. So I'll say I'll access those resources. But, obviously, this is why it's important to have a relationship with your banker, whoever that banker might be, correct? Because obviously every bank, every financial institution, in this case, we're talking about Wells Fargo, and we have put in the chat a link to business resources. How important is it? Because I feel like Gen Z, right? And I always talk about my two college age kids who are 20 years old, and if I ask them, who's your banker? They'd be like, are you kidding me? My banker's my app, right? It's only the app. It's only the phone. But how important is that, for me to be able to be like, hey, Luis, like I have this question or this problem, or can you give me some guidance? What do you see as that human interaction and connection and the importance on that, particularly with younger demographics that don't have that, my mom who is 83 years old, she still buys like these chocolates for Christmas for the bankers and goes and gives them as a gift, right? Mm-hmm. Where you think about Gen Z and they don't even know a human at a bank. Right. So what is that give and take? Not to say that you have to come and give chocolates to every banker, but why is that important?
Well, everyone has a unique case, and everyone's business, their business model, your business plan is going to be different, and every banker, has different experience working with different types of businesses. They're able to understand your business trend, they're able to understand how it works, how you source things, how things happen in your business. Why is it that you had delay in paying some of your invoices for a month or two? What is all this that we need to explain? And like anything else, right? Whenever you go through that process to acquire any type, and even when you're looking at both types of capitals, dilutive and non-dilutive, it gets even more intense. I mean, when you're looking at the dilutive capital investors, I mean, going to a banker is easy. Going to the banker is a lot less of a rigorous process than convincing investors to invest in your company. But it remains the same. It's like, what relationships did you build? How can they understand how your model makes money? And and is this a viable investment, right? Because when people look to invest, they want to make sure they recuperate their costs. It's the same thing, right? Whenever you lend money, people want to make sure you can recuperate that investment. And so that's very critical. It's important to understand so that people know who you are and people understand that. And oftentimes having that relationship, it gives you a historical perspective of saying, oh, look, this person has been banking. We see your cash flows. We see what your deposits are. And usually it starts with the personal checking, right? You go in there and people open up a bank account. And there's a history there. It says, oh, look, we can see how your bank has been operating with you.
Right.
And so that's the importance, because it creates a historical record of a relationship that you have with any financial institution, for them to be able to say, oh, this is how we can potentially work with you and what your business model may be.
That's so critical. So yeah, that's a very big, I think, an important takeaway for everybody watching. Like, do build those relationships with your banking institution, with your banker. I know sometimes it's very convenient to have the app. We're all on the go and want to have everything immediate on our phone, but building that human connection, that relationship, like what you're saying, that historical of who you are, what you've done, what your previous companies might have been, etc., definitely is going to work and play a role.
Right.
Fantastic. Okay. I want to go a little bit back. I mean, we're going to get to the dilutive capital, because I know some people definitely want to know dilutive capital. They're like, I have a startup and it's, I want to be venture backed. But before we get into that, I want to go back to lines of credit, I want to go back to loans. And going back to that example that I gave of someone who once told me that they wanted to do a restaurant remodel, and they're like, and you're the queen of venture capital, so, help me raise venture capital. And like I said, my answer was, I don't really think you need venture capital. This is not a tech company. This is not something that requires massive immediate growth. I just couldn't see the fit, right? And we'll talk a little bit about that. And what she had said to me was like, no, and I was like, why don't you just get a loan or a line of credit? You own the building, you own the land, you own everything. Like, it would be so, you're profitable. Like, how easy would it be to have a loan or a line of credit? And her response was like, no, I don't want to do that, because if something goes wrong, the bank will take my business away. Right. Yeah. And I thought, wow, that's so interesting to get this response, because if something goes wrong with venture capital, they'll also take your company away. And also, it's not about taking your company away, because if you default on a loan is very different than, okay, how am I going to be able to pay it? You work again with your banker, you work on how you're going to get through that. Whereas in venture capital, immediately, even if you meet all of your goals, you're already giving a piece away of your company, right? But I think people confuse that in a way. So we'd love to hear your perspective on that.
Yeah. So, it's important to understand, going back to the basics, right? The different types of lending options you have. And I'll just kind of list some of those. When you have let's call it seller financing. All right. So many times right now you see that happening a lot, because there's a lot of, it's called the gray tsunami. A lot of, folks that baby boomers are retiring. And a lot of these businesses that were started are being sold off, unfortunately, right? Because, kids don't want to run them. Like you mentioned, other folks saying, hey, I don't need this. I don't want to sit there and run a laundromat. I don't want to run my parents' tax business. That's not what I want to do. Okay, so people are selling off. So there is that option for seller financing, where when you do sell, or you want to, the seller or the person who you're buying the business from will back that difference that you need, right? So that's one option that's really creative, and that's something you can look into, which is seller financing. The other we talked about, which is factoring or revenue-based financing, when you're lending off your invoices. The other is peer-to-peer financing. That's what friends are, your community of friends. Say, hey, friend, can I borrow some money from you? I'm happy to pay you back at X%. Or what options do I have for that? Crowdfunding is also very popular among entrepreneurs. That's an option for people to say, let's raise funds. CDFIs, I would have told your friend that if she's looking for money for remodels, improvements, things like that, it's a short-term loan, something that's going to help her business grow. Their community development financial institutions, or CDFIs, that's a great resource. They provide that community-based lending model. So they operate similar to banks, but with a different lens. They're capitalized a little differently, and they're the ones that you see often doing a lot of the lower level of lending. Some of the smaller CDFIs may only lend up to like 75,000, but
that might be enough.
And they provide you with a whole wraparound service for that. And so community development financial institutions are completely something to look at. And then finally, you mentioned it, grants. A lot of organizations, just using this case, right? A lot of professional organizations often support grants for people in that industry. And so there may be options to look at government grants, federal grants, back grants. There's so many different opportunities. So before you say, I need someone to come in here and take a percentage of my company so that I can remodel the kitchen of my restaurant. There's a lot of things to look into, right? And a lot of ways to operate. Now, for those that do want to go that route, then you have to ask yourself, what is the goal of going that route? Most entrepreneurs that want to go the dilutive route want to, have a vision that they need to sell, because that's what you're selling to investors to raise that capital and then make decisions that inevitably end up with you selling off that asset, right? And I think that's what most folks would like to do, right? They say, I'm going to build this amazing company and I'm going to take it public and that's it. And I'm out, right? And I'm going to make all this money and continue. And that might be the plan they have, right? But again, it's up to you. Why do you want to take on and what's best for you? That is a complete personal decision for you and the plans that you want to make, but both are very viable options.
Yeah. What you might want to do, but also what your business is and that it needs, right? So sometimes I think that's why it's so critical to really understand the different types of capital. We've been talking a lot about dilutive and we will get into it. But before we go there, I want to make sure that we go a little bit back, even for my own just education. And can you tell us a little bit more about CDFIs? Like, what is the difference between a CDFI and a bank? Sometimes I know banks fund CDFIs, right? Because I know like Wells Fargo will give funding to CDFIs, like for example, Grameen America that gives microloans to women in the community, et cetera, or just to anybody that needs a smaller loan. Can you talk a little bit about that? Like,
sure,
the difference between CDFIs and banks, and what sometimes is the relationship of how banks fund CDFIs, and exactly why are CDFIs able to get you maybe sometimes a better interest rate or take a bigger chance on you if you don't have all those perfect financials, maybe.
Right. So community, it's in the name. It's community development financial institutions. So the core of a CDFI is to focus on community development. And that's what their mission and purpose was. When they were created and CDFIs were put together as part of the financial industry, they were built with the purpose of being able to support and provide capital to communities that for the most part were underrepresented in the business or small business arena. And that's across the spectrum, rural communities, urban cores, it doesn't matter where you're at. CDFIs were built. Now they are funded as differently because they are different. They are technically a nonprofit organization.
Okay.
So a CDFI does not.
Are they all nonprofit organizations?
There's going to be variations on how they operate, but for the most part, yes, they are funded as nonprofit organizations that have a specific opportunity to lend in ways that are completely different, and they can take on more risk than a traditional financial institution. And that's very important, but they're still limited and capped by some of the certain requirements, because oftentimes CDFIs are funded by the government, by bank grants, by philanthropy, by different folks in the community that are able to support. And so they're able to take that money with the intent of lending it for community development purposes. So if you have a business, they want to see economic growth in communities, they want to see job creation. So a lot of times when you go in with your business, they want to be able to support your business and say, hey, this is how we want to work with you. And they can take on the risk, because oftentimes if folks that don't that they're building credit or trying to build credit, the CDFI has programs and mechanisms to help offset that risk that banks do not. And so the purpose, of a CDFI was really to serve as a springboard. At least that was the initial intent, right? Is a CDFI, you would start off your business or a microloan, even say, hey, I need $5,000 to start my food truck. Mm-hmm. The CDFI would be able to underwrite, build, because you don't have revenue, you don't have any money yet, so you're just like, hey, I want to start my business. So CDFIs tend to be the first step in doing that, because they can take that risk, because often their programs are funded through philanthropy, like through the work we do, or through government grants and programs. So there's a risk, but it's a little bit different.
It's almost like a subsidized risk.
It almost is like a subsidized risk, but every model is different. Every CDFI is different. That's why when you want to find a CDFI partner, and there's a lot of resources online to do so, then you can go ahead and then decide which CDFI is best for you, because again, they will all offer different programs and services. Some focus specifically on microlenders. Those are like the folks that want to set up a shop in the corner and they want to do microloans for their taco stand, or they want to do like your food or ice cream truck, whatever it is. There's different programs where On the financial side, most folks want to see solid 2 years of business revenue. So if you don't have that revenue, you're trying to grow your business, you need a little bit of capital, and you have a purpose that's going to support the community. CDFI is probably a good option for you to explore.
Could be like the first stop.
Correct. And what we do, we have a program called Small Business Resource Navigator at Wells Fargo. So when people want to apply, and unfortunately, for example, it may not work or will not be the best fit, we, through our partnership with the community, with CRF, are able to put together and direct you to a CDFI that would probably take on your loan or perhaps evaluate your loan as an option. So that is a great resource that we offer for folks as well. And that's open to anyone who wants to see the website. We're happy to share that link with you.
Yeah, I hope that we can put that link on the chat too. So people who want to learn more about CDFIs. That was my next question going to be. I was like, okay, I'm lucky that I do have a relationship with my bankers. So if I had an idea for a new business that required a small amount of capital, I did not have solid 2 years financials, you might say not ready yet, right, for a Wells Fargo loan or any other bank loan, but we can point you to the right partners that.
Right, because and it is and that's called ecosystem, right? When you look at your building capital, we talked about like the capital stack, right? Which we should talk a little bit about, but it's also your ecosystem, right? Who are your lenders? Who are your resources? Where's your technical assistance? Who's guiding you and giving you advice? All that is part of that ecosystem, right? So yes, you need to know what ecosystem exists in your industry and in your areas. That's why there's professional associations and so forth that can connect you to who can help you and guide you and helping you achieve your goals as you build that up.
Okay, perfect. All right, we're halfway through our session, and we do want to leave enough time to answer questions. But let's talk about dilutive capital, because I know you also know a lot about that. I know Wells Fargo has a fund as well, so that is also a different route to go and a very different route traditionally. And this might not be true for anybody, so correct me if I'm wrong, or if you want to add anything. Traditionally, if you have a capital intensive tech, for the most part, big idea, raising capital from dilutive sources, from venture, which is what it's called, the typical VC, is something that you can do. And sometimes you don't need 2 years of financials, right? You need a big idea, and you need for those investors to believe in you. That's right. So when you start, I guess you could start with a typical friends and family round that many of us Latinos don't have a lot of friends and family willing to just cut us checks for millions of dollars, but some of you might, and that's amazing. But if not, you can go to crowdfunding. That's another one. Or you can then say, listen, I think my idea is big enough. I think I have people who absolutely believe in me as an entrepreneur, and that I can be the person that can pull this off. And then you can start raising capital that way with no financials. But it's still hard to convince them that you are the one. You are that unicorn company that's going to do it.
That's right. Yeah. And I think that's a whole different approach, because even so, you may not have a business model that shows revenue, but you should have a portfolio, a background in the work you're doing, right? I mean, everything that's done in the capital space is about measuring risk. I mean, and it's something that everyone should be familiar with, is saying, hey, what is my risk factor? How much, what is the right potential to pay back, right? When you go buy a mortgage, right? Most lenders say, we want to see your debt to income ratio to be no more than 50, 50% is high, but they'll say no more than 50%. And so you need to understand that. What is your debt to income ratio for your business? How comfortable are you, right? And taking on debt or bringing on investors? And then what does that percentage look like, right? And this goes back to that budgeting and basic credit check and everything that you got to do in your business, to then ask yourself, does that make sense for me to take on investors, right? And what is it that you want to accomplish by doing so? It is a very personal question, because it involves you having an idea, bringing on other investors that can eventually tell you how you run your business.
Absolutely.
Why you want it, the direction you need to go. You may say, I want to paint this building white, and they tell you, no, you're going to paint it red. And you may have no choice but to say, I have to paint it red. But again, it may make sense for you if you're in a situation that you really want to see rapid growth, you see a lot of opportunity for investment, and more so, you have the understanding of how investing works, the different types of investment options. You have angel investors, you have, different kinds of funds, that are willing to take on, and then decide if this is really the direction you need to go, and what is your purpose, right? And again, there's a lot of folks who don't go down that route, simply because navigating the series, right? Because you have to understand, if your goal is just to raise capital and see your business grow, that may work. I mean, there's some folks that, look at this and say, hey, I just want to see my factory that I have. I want to open up 2 more factories, and my goal is to generate X amount of revenue, and I need to do this by XYZ investors, and you're factoring how much you're going to pay back your investors, so you know exactly what your target is. So some people can do that if they know the back end of how that works. Now, there's maybe other individuals who are thinking, this is great because I'm going to make all kinds of money when I get my investors in here. And it doesn't really work that way, right? You have to understand exactly that process, because then they're going to ask you a series of questions like, have you done this? What collateral do you have? What assets do you have? Right? You're going to get into questions like that. What debts do you have? How long have you been in business for? Can this business really sustain the demand that you're telling us it can sustain? And what's your exit strategy? Because that's also something that all investors want to know. So it takes some time. And again, it is an option because we want more people to see growth. We need to see small businesses develop into stronger businesses, and everyone wants that. And it is one option. But you have to be ready to understand what that really entails and if you're comfortable with that.
Yeah. And just to go back for people who have not heard about venture capital, this is a capital that you don't pay back, right? I mean, unless you're doing maybe a more of a loan from investor. But if an investor invests in you as a VC, for the most part, you give up a portion of your company. That's why if you've ever watched the Shark Tank, I mean, I think that would be the perfect example of okay, what's the valuation? And that depends on all kinds of factors. How much traction do you have? Do you already have revenue? All these things add up to a formula where it's okay, your valuation is $1 million and you're asking for $100,000. So, you're giving away 10% of your company, for example, right? And it could be much more, much higher. But you can, I've talked to some entrepreneurs where they're like, I have an idea and I'm going to raise, $5 million. And I'm thinking oh, how are you going to, what's your valuation? And they're like, oh, my valuation's 50. I'm like, no, this is not stuff you make up. It's not like you just assign yourself a number. So all these things you need to learn, obviously. So you're knowledgeable. The more you give up, just like Luis was saying, the more those investors will be telling you exactly how they want you to run your business. When you lose control, they'll be on your board. And I'm not saying that this is bad. This is the only way I've personally raised capital for my company. So I might sound negative in this, but I'm listen, it's not free money. I think it's very glamorized of oh my gosh, you've raised so much money from these investors. First of all, it's a grind to raise it. Second of all, it's not free money. It's never free money. Yes, you don't pay it back, but you pay it with control of your company. You have a board that tells you what to do and you report to this board. Sometimes you might not be in agreement to and sometimes it could be amazing. You can have incredible investors that not only give you capital, but give you a lot of their intellectual capital. They really know your industry. They have exited from other big companies that they've built that could be similar. So there's a lot of positive there, even by having somebody to report to in a board that know more than you. So there's not one right answer, right? It's who are you? What is your company? What are your aspirations, like you're saying? Right. And the more education that you can have, the better. And I think obviously in 1 hour, we're not going to learn everything about friends and family, pre-seed, A, B, C, exit, capital growth, but it is available online, and it is important for everybody to understand what you're doing.
And you mentioned, and it is paid back. I mean, you have to pay your investors. I mean, as you invest in this, right? And I think that's the other thing to consider. And depending on the structure of how you set that up, you may have to pay quarterly, you may pay yearly. I mean, it depends on the deal you structure. That's why it's so critical.
Or when you sell it.
Because the reality is everyone has a different approach to that. But that's something for you to consider, because that's added pressure. Some folks, you got to make quarterly sales now. You got to hit targets that oh man, I got to make sure I get this, because if not, my investors,
we know a lot about that. So the next board meeting will be a bloodbath.
But again, that makes sense if you have a business model that's doing that, and you see that happening a lot in the tech side. You see a lot that happening on the fintech or healthcare, which is something that all those investors they have. Healthcare financing is completely different, but it is a different option. If you're a doctor, dentist, veterinarian, there's options for those types of financing that's a little bit different because they understand the type of work you provide. So that's something for you to consider as well, right? And that's why the relationship with your banker is so important, because they'll tell you, oh, you're going to start your practice. You want to start your dentist, practice, or you want to do whatever it is that you want to do in the healthcare space. There may be programs that are going to be a little bit different than your traditional based financing.
Okay, perfect. Well, we could spend days in each one of these options, but obviously we don't have so much time. We have 20 more minutes. I want to make sure that we get to some of the questions that we have here. Here's one that says, how long is the recommended period for taking out a loan to start a small business? I guess we kind of answered that. Depends when you're ready, right? And that's for venture, that's for a loan. When do you have everything ready to go out is depending on what loan. Are you looking for a CDFI small loan? Are you looking for a bank loan? Are you looking for investment? Right. Depending on where you are.
When you're in the starting of your business. So again, and I want to use the word starting because you see startup, you're thinking like, oh, I'm ready for the investment. No, we're talking like, you have an idea and you're thinking, okay, my local, I don't see a juice bar in my community and I want to open up a juice bar as an example. That funding, right? You have to understand, how much you're going to need, right? Because the first thing is a challenge is how much money do you really need? Sometimes people think, well, I may think I need 100,000, right? Or I may need 10,000 until you know the basics, right? So the first thing is understand how much money you need for your capital investment. Second is then look at your when you're starting your business, you have to take a look at your financial snapshot. Like, what is it? What can I budget? What can I afford? And then, you start looking at ways that you can then start using like the CDFIs and other folks before you. So you're going to need a loan when you need to start your business, but you need to understand how you're going to collateralize that loan. Mm-hmm. And then, and in some cases, if you have outstanding credit, then you may not need to, have a secured loan. You can, based on your credit, like you go open a credit card, that's the same thing. You can use that to do that. And, a lot of folks in the business community, when they start, oftentimes that's what they end up doing. Right. Yeah. They end up taking out personal loans, or they end up, borrowing from friends and family, or using their own credit, right, to go and say, I need to buy my food truck. So here's how I'm going to do this. But it's important to do this and also have that guidance you need. And that's why, look at financial institutions as guides, not just giving or lending money. It's to get these resources. Like we just posted right at the resource page. There's a lot of folks out there who can guide you in that business model. Say, okay, well, look, before you start doing this, have you thought of this? Have you thought of how you can do this? And that's why it's important to have that relationship with.
Do you guys do that for your clients?
Sure. Our bankers are there to answer questions, to kind of better learn. And again, with any financial institution you go to, they're going to be there to be able to understand your business and understand a little bit better, right? And some folks need to learn your business because there's some very unique ideas out there that, need more understanding. And that's why you need to have those conversations. So when you're ready for a loan, when you have an understanding of what you need to answer that question, and when you are, have a solid business plan as well, because oftentimes that's overlooked. You need to have a business plan. When you don't have any capital, you don't have any revenue, you haven't even started, the first thing everyone's going to ask you is, what is your business plan? We'd like to see your business plan. And that's going to include forecasts, projections, market. Everything goes into a business plan. And that's why CDFIs or nonprofit organizations are so critical, because they can help you build that business plan.
Oh, that's great. Because that's not easy, right? Like if you didn't go to business school, how would you even know how to build a business plan?
That's right.
And it's very detailed.
Very detailed. Enough, to show that you understand the business you're trying to start. It's not just like, I have an idea, but take your idea now and explain it in terms that assess the risk in it, how you're going to build it, what is your loss potential, what is your growth potential, all those things, your competition, your market share, all these things are part of your business plan. So when you're ready to have all that together, now you're ready to say, okay, now I'm ready to go look for money. So if you haven't done the basics, right, haven't gotten your credit, you haven't gotten your budget, you don't know the world your business you're doing it, you don't know the cost of your business yet, then you're not ready yet to access capital yet, right? Because these questions are going to be asked by anyone you go to.
Okay, so credit is something that seems like a very, very first step, even before a business plan, right? And to your point, even when I've raised venture capital, they run my credit, right?
Sure.
They're not banks, but they're like, I want to see that she's solid, right? Like she's never declared bankruptcy or that, like we can trust her with our investment. So even if you think, oh, this is not going to go to a bank, will be VC, they will run a credit score on you personally. So that is what is very important. So what steps can entrepreneurs take to improve their credit and make themselves more attractive to potential lenders, whether it's a bank or whether it's venture or any other type of loan? What are the must-take steps?
Yeah. Okay. There's a lot of things you can do. The first thing, it starts with your personal credit, right? You want to make sure that you're making your payments on time. You want to make sure that you have a budget that you can do. You want to also understand that how you use your credit, right? You want to look at, are you paying off credit? How much debt do you carry? Because that's also very important. I think everyone knows this, but when you're looking at traditionally your credit bureaus, nobody wants to see you more than 30%, debt on your credit. So let's say if you had a $10,000 credit line, you shouldn't be using more than 3,000. And in a perfect scenario,
3,333.
Yeah,
better keep it at 3,000.
But that's exactly the whole starting point of this. So oftentimes before you go in there, you have to say, okay, I need to maybe pay down some credit, or in some cases, if you have it, you got a credit line when you were 18 years old. And now, you're a professional and you haven't changed that, but you still have it on there. And you only have five, ask for an increase, right? So that way it doesn't seem like every time you're using the credit card, you're maxing out that 30%. So you have to go through that, right? And then that's what a great CDFI does and other organizations, because you get a lot of credit counseling. But yes, credit is the first step, because then you build a credit history profile, right? Lates, you want to get relates. You want to follow all the things that on your profile that show that you are not you're not credit worthy, right? And I think that's something that all of us struggle with collectively across the country. But you really want to start seeing your scores go up. So it takes some time. If you're planning,
how much time? Like if your credit score is not great, like what do you think it would take to not clean it up, but make it look a little more, put a little makeup on it?
It's case by case basis, right? I think the biggest thing that everyone knows, and again, there's a lot of great organizations that can help with credit counseling. That's what this is called. But through credit counseling, you can look at those lates, right? And there is ways that you can, pay off a credit, get a rapid rescore is what it's called. If you're looking for a loan, if you say, okay, I paid off the car, I paid off what I have, is that going to give me an opportunity? There's things like that, but you got to talk to your personal financial, advisor or banker so they can walk you through that. But I will say that, it takes, some time for you to plan for that credit ask, right? The other thing is how much your debt ratio is, right? And that's really the biggest challenge when you're starting to look at your business, right? You're trying to create cash flow. You're trying to think of your business, but then you got to go get a loan, right? And it's like you have a mortgage or you have a car loan, or you're already capped, right? Because everybody wants to keep it that 50%, and that's not everybody, but that's just a general rule of thumb. And so you have to start thinking. It's like, okay, what areas can I bring down? That I can have my credit scores. What can I do now to address that? So that takes some time. And so it's individual, it's case by case, but it's things that you should know and that you should start planning for if you are in a business scenario. Credit is critical, it's crucial. Make sure you understand how it's used and then go out there and start building that credit. And there's a lot of great things you can do, and I think most folks don't understand or learn about credit management until, as adults, but there's ways that you can do that when you're younger if you knew how to do that. And that's why credit counseling, CDFIs, business resources, again, all that information is available.
Okay, not to plug our own resources, but our own resources are amazing, and we've been definitely supported by you guys with grants on this. But we have really fun, comical videos on how do you up your credit. We'll explain with tacos, with arepas, with whatever is necessary. We'll explain soft and hard credit inquiries with a soft tortilla versus a hard one. Yeah. But those little things that I learned at Suma, I have to be honest. I had no idea that if you close down a credit card, that could affect, because length of credit, like we say, is one ingredient in your good taco, right? In your good taco credit. And I didn't know that. I was like, now I'm like, keep it at 0, put it in a drawer, but length of credit is important. Or hard and soft credit inquiries. The other day I was on a flight and this flight attendant lady is passing on these like credit cards, right, from the flight, and somebody asks, is that a hard credit inquiry? And she's like, no. I'm like, yes, it is. I learned that at Suma. But yes, be informed. I think, being informed is the most important thing. I think education is critical to our community. We try to do it super fun, super in culture, even funny, in a funny way. And obviously we are in partnership with you guys, and we're always grateful for that. But it doesn't need to be boring. We promise you ours is very fun and easy to understand.
For a business, it's also another thing, and that's personal credit. But for your business, a couple of things to be mindful of that can definitely show up. And then here's a couple of things you can do. One, accelerate your inflows, right? You got to bring in that money as fast as you possibly can. And that's where you have to process invoice quickly. You have to show that you're bringing in that money. That's important to show, right? Because when you look at your books, you want to show that you're actually getting paid for the work you're doing. So that's important to be able to do that. Track your costs. You have to look at, what you're spending on. What does that look like? Make sure your payroll obligate. If you have payroll, if you have employees, make sure those are being met. Pay your taxes. That is very important. Oftentimes, people think I'm going to do a cash business and I'm not going to report taxes. That's not the way you want to go. You need to show taxes. You need to show that you're paying this, because that's part of your credit history. It shows that you are able to pay back your obligations. So it's harder to not have that history and then expect to get, loans, because obviously you don't
exist in the system.
Hey, you haven't done this. And then monitor, keep track of your cash flow and cash flow. We talked about this. But, cash flow is the lifeline of your business. You have to show that you have the cash flow to pay your bills, pay your employees, generate a revenue, pay all those things that we talked about. So when you look at those folks that may be looking to start their business, is make sure you understand how you're going to manage your cash flow. Make sure that you understand how you're going to keep one amount in the bank. What's going to be your limit? How are you going to make sure that you can show that you can pay your bills and see that coming out, right? So those are things for you to think of as you're starting to put your business together.
So a lot to unpack, but we've put links to resources that can be, valuable to anybody watching this. And you will need both. You will need to have great credit personally, and obviously obviously it's the ideal that you have both, because if one doesn't check out, I think that also is a red flag, right?
Right. Yeah, and there's a question here. It says, are there specific small business loan programs or grants that Wells Fargo is prioritizing for 2025? There's always things that we're evaluating. The whole point is to support business growth. Business growth, economic development and growth is good for the entire country. It's good for our communities. So there's going to be, different opportunities throughout the year that you focus on credit options or looking at ways that you can support. Again, that goes down to your personal relationship with your banker. So to answer that question, if you are, looking to connect with the Wells Fargo banker, they can guide you a little bit more in terms of things that are happening, as things are always changing. We're in a very dynamic environment when it comes to entrepreneurship and things that are happening and things that are changing. So there's always opportunities to evaluate how we get folks to grow. And that's the whole point of lending capital, right? Is to grow. You want to see capital that can help businesses grow, take them to that next revenue bracket, help them develop. One of the things that we want to see is help people get employment, right? Employment is so critical for our economy and our communities. And that's something that we talk to with a lot of entrepreneurs, to say, hey, it's one thing to be self-employed, which is great, but it's also like another thing to say, hey, I want to start hiring people, because that changes our economic, outlook for our communities or regions as a whole. And that does create a whole different, opportunity for growth. So all these programs are tied in there. There's a lot of solutions that are offered through banking institutions, payroll, merchant services, all those things that come together that a business needs to run nowadays. You need to pay credit cards, you need to be able to do all these things. So that's why a relationship is so critical, because each business is different, and what you may need is going to be completely different than what other people may need.
Talking about credit cards, for businesses, do you recommend that people try to, as soon as they can, have, just like they should have a business account and not be mixing personal and business?
Yes.
Same with credit cards. And how difficult is it to get a business credit card? I mean, I guess that definitely is based on your own personal credit if you're just starting your company, or how does that work?
Yeah, when it's like anything else. When you're starting your company, it's like starting your credit history from zero as well, right? But there is a lot of processes, and again, it's important that you talk to your financial institution, because they have programs that can help guide you through understanding how to do that, how to build that credit, and what the best options would be. And those are conversations you need to have with your financial institution to give you a little bit more insight on that. But yeah, absolutely. It's going to be a little bit of a process. That's why entrepreneurship is a lifestyle, right? You have to be comfortable with the growth. You have to be comfortable to challenge yourself and know that, hey, you're going to do maybe great for a couple months, and then the other months not so great, and then you do great again, and then it goes in the cycle, right? And that's exactly how this works, right? But you have to be ready, for the good stuff, and then you have to be ready when things kind of a little bit tight, right? And that's every business that you see. So oftentimes you will see on a graph, you'll see businesses do this, but you want to see it trending up, right? You like anything else, like the stock market and all those things. So you have to be sure that you're building your business model to be strong, to be successful, to be able to resist, and have an exit plan. I mean, disasters happen all the time. Right now we're in the information technology sector, right? I mean, you're seeing cybersecurity threats. You're seeing all these things. So, traditional disasters, fire, earthquakes, floods, all that applies, but you have to be resilient enough to say, well, what happens if I don't have the tech infrastructure? My entire system got compromised, So you have to be mindful of how you build your business and make it resilient.
Right. Perfect. Excellent. And again, look for these resources. Obviously, if it's anything related to your finances, with your banking partner, with your financial institution, but even as how do I become more AI literate to grow my business? How do I, grow my company through learning how to do low customer acquisition costs, all these things, the resources that are available. We have plenty at our Sumaversity that are 100% free, and we've had Wells Fargo as a partner subsidizing that free education. So by all means, take advantage of it. We have a couple of minutes left, and there's a lot of questions about grants, obviously, right? So you only have 4 minutes, amigo, to answer this. But who should apply for a grant? Is it only nonprofits, or can small businesses also apply? Yes. What are the things that you look for? Can you give us a little bit of a, right, 101 on that?
Okay, yeah. So I sit on our philanthropy side, and obviously on our philanthropy side, our grants are done through nonprofits specifically, right? And these are organizations that are doing work on a national scale to support economic development. But as individual entrepreneurs, yes, there's a lot of loan programs that are taking place in your communities, in your region, that you can reach out to. Your best point would be, yes, to go through your CDFI partners, because a lot of them do provide the grants. Look at the regional resources that you have, professional associations, regional chambers of commerce. They also are plugged into that ecosystem to look at what grants are available for you, and any business could apply. And there's a lot of grants out there depending on the need and what you do, right? And that's why it's so specific to industry. If you're in agriculture, there's grant programs, for agriculture. If you are in tech, there's grant programs for tech. If you are in engineering, right? Energy right now is a big topic. There's grants for energy development. There is pitch competitions, pitch programs. A lot of organizations are out there that we work with as well that provide these opportunities for business owners. So the challenge there is for you to find them in your local community.
Okay.
Because a lot of these are very specific to the region. Some of them are national, but for the most part, the real effort happens at the local level, right? So if you're in one region and you want to see a regional input, what grant is doing to support you in Chicago and New York or LA, wherever you may be. So you have to make sure that you look into that as well, and follow through that ecosystem. So there isn't just one centered. I wish it was that easy where you can say, hey, here's one.
I go here and they're all
as everyone. No, it's all based on your community, the community nonprofits that serve entrepreneurs. Also, the counties or the local government offers programs. You may want to check the county small business resources wherever you may be. They put together a lot of programs and grants that are available for businesses. And so there's options, but you have to go out there and look for them, right? And that's part of the entrepreneurship lifestyle, right? That I wish there was a giant bat signal that says grants here, let's go, but unfortunately, there's finite funds like anything else, right? And so they may not, some of these grants may only be able to support 50 or 100 or small businesses in a community, and so you have to be constantly involved. So that's why build relationships with your financial partners.
Right. Yeah, because they can point you to what's coming up, what's opening up. Okay, perfect. Excellent. Well, listen, we have 1 minute left. Any parting words, anything that we didn't touch upon that could be, a final word or phrase of inspiration to small business owners, to entrepreneurs?
You are the lifeline of our economy. 99.9% of our entire economy relies on entrepreneurs, small businesses. And so keep the fight, keep going, keep looking, keep growing, keep expanding. And the challenge is to look at the next evolution for you, right? And to help those that are also looking to develop, share those resources, take advantage of these resources. Back in the day, you had to go to the library to get this. Now it's like just click on, and on the palm of your hand in our phones, you can have all this information. But please go out there. I hope you learn something from these opportunities and take advantage of the resources that are out there for you to continue to be successful.
Thank you so much, Luis. I really appreciate you personally, appreciate our relationship that we have with Wells Fargo, always supporting our community. This was great. Obviously, 1 hour is never enough to talk about raising capital, but hopefully this will be the first of many. And do look for resources within your own financial institutions. If you're lucky enough to be a Wells Fargo customer, obviously, you can find them there. But there are resources available for you everywhere. So thanks again for your time, amigo, as always, and thank all of you for being here today at this Suma Power Hour. We hope that you found all of this conversation and some of the resources that we put throughout in the chat useful. Thank you.